Hello everyone, this is ACC Amit Kumar. No, this is working now. Hello everyone, this is ACC Amit Kumar. If I share a brief about me, I've been training on IFRS and Ind AS since 10 years now, and I'm here to discuss with you the employee benefit plans. So Ind AS 19 is the standard for dealing with employee benefit plans, and employee benefits are of various types. Some benefits are given to the employee within 1 year. Some benefits are given to the employees if they serve the firm for a longer period of time. Some of the benefits are given post employment. Employee has completed the service with the firm and they've retired, or if they have left the firm, not only retired, even there are benefits like gratuity which are given when an employee leaves the firm. So post employment benefits are given to an employee if an employee leaves the firm. They are not given to the employee while they are continuing with the firm. So there are defined contribution plans, there are defined benefit plans. Defined contribution plan is like provident fund is a defined contribution plan. A fixed amount is provident fund is a defined contribution plan. A fixed amount is being paid to the fund by the employer as well as employee. The employer will not pay beyond the amount which they are entitled to, which they are required to contribute to this fund, which they have committed, and they'll be contributing an amount equivalent to what an employee contributes to the fund. Employer is required to contribute similar amount. So whatever amount they pay to the fund, howsoever the fund performs, it is the risk of the employee. Defined benefit plans, the benefit is defined by the firm. They define the benefit. Now the benefit is defined by the firm in the sense that they are like pension plans. The benefit is defined by the firm. Gratuity. The benefit is defined by the firm, that after the employee leaves the firm, the benefit is defined in terms of like 1% of last round salary for each year of completed service. 1% of last round salary for each year of completed service is the benefit is defined. What is the benefit? Benefit is 1% of last round salary. Now how much will be last round salary? How will you get to know? The last round salary is based on actuarial assumptions. We don't even know what will be the last salary of an employee, and there are 5,000 employees working with the firm. Do we need to get prepared for it? Shall we be prepared for this liability which we have to meet? And every year there may be some employees who are leaving the firm. The entity needs to meet up those liabilities. So how do we prepare? How do we be prepared for this liability? We take the help of an actuary. Actuary, on the basis of some actuarial assumptions for the pension plans and for gratuity, will give us an estimation on the basis of attrition rates, on the basis of demography, mortality rate, life expectancy, attrition rates, employment rates, various forms of information used in arriving at actuarial assumptions. Actuarial assumptions. Now these actuarial assumptions are based on various forms of various factors which can be the reason for the increase in salary or decrease in salary, the growth rate of the company. There are various factors, like we cannot predict it as an individual. Without these assumptions, it's not very difficult to predict it, and even these predictions are not very accurate. But it's like something is better than nothing, that at least there should be an estimate which is closer to these actual figures which happens, and we are somewhat able to record something which is closely approximation of the amounts which will be. Exactly we cannot predict. Same is the principle for hedge accounting. Like we cannot exactly set off the gain or losses. We can minimize the exposure to risk. In similar manner, we cannot exactly know the total amount of liability, but we can at least come closer to the amount of liability. Even if we reach that level, our accounting is fairer. So post-employment benefits. Among the post-employment benefits, there are two kinds of benefits. One is defined contribution plans, and one is defined benefit plans. Defined contribution plans are defined contribution. The contribution by the firm is defined, they will not pay beyond that amount. In case of defined benefit plans, the benefit is defined. And if the liability increases because of the defined benefit, the entity will have to make up for the loss. If the liability reduces, that's a gain for the firm. Because the benefit is defined. And what is the benefit? The benefit is 1% of last loan salary. And last loan salary is not known. And if you have 5,000 employees, 10,000 employees, how will you predict the last known drawn salary of each employee? So there has to be some actuarial assumption. Is the reason we take the help of an actuary for calculating these defined benefit plans. And in today's scenario, there are very few companies who offer defined benefit plans, though gratuity is offered by most of the companies. But pension plans, even the governments have left them out of the scope of the benefits provided to the employee. Very few companies now interested in paying pension plans, though gratuity most of the companies are still paying. This is least popular now, but still there are some companies who think of the employees, give them pension benefits even after they retire, even after they leave the firm. The ones who do not retire, suppose an employee completing 5 years with the firm is eligible for gratuity. If they consistently remain with the firm for 5 years, after that if they leave, they become eligible for gratuity amount as well. And that too is defined in terms of say 1% of last known salary for each year of complete service. And the name is clear, post-employment benefit. Once the employee leaves the firm, the employee is eligible. If the employee continues with the firm and there are some other long-term benefits, these other long-term benefits are when an employee is continuing with the firm. These are rock awards, solid foundation awards. An employee is with the firm for 10 years, for 15 years, for 20 years, for 25 years, if there are defined benefits for completing that number of years of service. They expect the employee to continue with the firm. They don't wish that employee to leave the firm. If the employee has completed 20 years, they award him to encourage other people also to achieve that kind of feat. So these are expenses which are supposed to be paid by the firm to these employees, and even if there are some defined benefits for them, they should be recorded as part of profit or loss account. Even if there are actual assumptions used for those defined benefits which are coming in the category of other long-term benefits. Now other long-term benefits means the employee is continuing with the firm, and if employee is continuing with the firm, the expenses should form part of your profit or loss account. But in case of defined benefit plans, what happens? The employee has left the firm, is no more providing any services, and we are trying to predict the claims on pension benefits. There is some liability to be paid each year. There are some employees who are leaving the firm or retiring. So on the basis of that, we have some defined liability and defined assets which we get from the actuary. The actuary will provide us the fair value planned assets and fair value planned liabilities. And we are continuously contributing into a fund. In spite of making all those transactions, there is one amount which remains unrecognized. In spite of all the transactions, I'll show you all those transactions, which amount remains unrecognized. That unrecognized actuarial gain or loss is shown as part of OCI. That's the main fight of this standard. That what do we do if we record all the events and transactions, whatever we could, but in spite of that, when the actuary gives the figure, fair value planned assets and planned liabilities at the end of the year, there is a difference between what we have recorded during the year and what is the amount given by the actuary. There is always a difference. This difference is known as unrecognized actual gains and loss. We'll talk about it. Before that, I'll touch upon the other two benefits. The other benefit is short-term benefits. Short-term benefit is paid during the year, that is salaries, wages, paid leaves, sick leaves. This is charged to profit and loss account in the year in which it occurs. Other than them, there is another long-term benefit. Other long-term benefit, as I said, the employee is continuing with the firm, and if there is any accounting which we could do, we'll be doing it for the current year, and if there is any difference in accounting which we could not record, that will also go to profit and loss account, because employee is continuing with the firm. And this is a benefit which is offered to the people who continue longer service awards or any such award which are special category awards. Now these post-employment benefits are almost given to everyone. Whosoever leaves the firm, retires, they become eligible. Whosoever completes 5 years, they become eligible. But other long-term benefits are special awards, I think, which are given to very few people who achieve that kind of services. Though there may be companies who may be having it to a large number of people, but these are extraordinary feats. Like I noticed in some of the firms, 20-year award. They get some benefit for completing 20 years, 15 years, 10 years. They get some additional bonus or additional amount being paid to these employees, which is a charge to P&L. Other than them, the least popular is the termination benefits. Now, termination benefits are defined by the firm. The company policies define the benefit. And if the benefit is defined, the liability is recorded as part of financial statements. Whatever amount they are liable to pay, redundancy costs, which also comes through restructuring provisions or whatever the reason, they are all recorded as part of the liability expenditures, immediately recognized. So as I said, the main area which creates confusion in dealing with Ind AS 19 employee benefits is actually defined benefit plans. Rest all is quite simple. Expense account debit to liability, short-term benefits expense account to liability, other long-term benefits expense account to liability, termination benefits expense account to liability. It's very straightforward. We simply need to know what the entity is liable to pay, what is the amount or charge for the year. We charge it to profit and loss account, and if we have paid it, well and good. If we have not paid it, that stands as a liability as part of the financial statements. In the defined benefit plans, there is defined contribution plans. Defined contribution plan means the contribution to the fund is defined. If the contribution to the fund is defined, that acts as the expense account debit, credit liability. When they pay to the fund, the liability reduces. Now entity's liability is over. Once they pay to this fund, which is responsible for paying to the employees, the job is done. The best example is the provident fund. Now howsoever the fund performs, if you notice the rates get decreased, or in this COVID situation, most of the people had pulled out their provident fund. Whatsoever, and you must have seen ads also that investment in equity gives you more returns than the money in your provident fund. Better invest in equity shares. Better bring these shares outside and invest in equity shares. Various forms, various ways. People ask us to get this money out of these provident funds, invest it somewhere else, because the risk is with the person who is owning that provident fund now. It's with the employee. The risk is with the employee. Howsoever the fund performs, the employee gets return on these investments. the employee gets return on these investments. This is defined contribution plans. The contribution is defined, and if the fund, normally it is provident fund, whatever the employee pays, an equivalent amount is being paid by the employer. So it's in the category of 12% of basic salary goes to the provident fund. It keeps on accumulating. The government or whoever is owning that fund, responsible for paying interest, pays a fixed amount of interest. They decrease, they increase, howsoever is the risk of the return is with the employee. The employer has paid whatever they were liable to pay. Employer's liability over. Employer's liability is this. Once they contribute to the fund, their job is done. But in case of defined benefit plans, like I said, 1% of last known salary for each year of completed service. Suppose there is an employee with the firm who is going to be with the firm for 5 years. So we take the help of an actuary who use a technique known as projected unit credit method. We take the help of an actuary who use a technique known as projected unit credit method. We project what is going to be the liability, how much fund we should create. We project it on the basis of the current situation. Suppose the benefit is defined 1% of last known salary for each year of complete service, and we are expecting this employee to be with the firm for 5 years. Year 1 the salary is 7,000. Year 2 it is expected to reach at a growth rate of say 10%, 15%, whatever. I am assuming it to be 7,200, 7,600, 8,000 and 8,500. Suppose this is the growth the employee has received and it's in dollars. Like you may be wondering who will be working for rupees. So I'm just assuming it to be $7,000, 7,200, 7,600, 8,000, $8,500. $8,500 is the last term salary. For the ease of, don't be emotional, just for the ease of calculations I've taken a small amount so that we understand it easily. How much is 1% of last term salary? And how much is the last known salary? How much is the last drawn salary? How much is the last known salary? The last known salary is 8,500. How much is 1% of it? 1% of 8,500. 1% of it is 85. Projected unit credit method says that for each year of completed service, the employee is eligible to receive 1% of last known salary. So how much the employee is eligible to receive? Employee is eligible to receive 85, 85, 85, 85 and 85. 1% of last known salary for each year of completed service. The moment an employee completes year 1, the projected unit credit method, we are projecting a salary at the end of 5 years. Now this projected unit credit method is being used by the actuary. I am an accountant, I am behaving like an actuary. Just to explain this concept to you, I am behaving like an actuary, though I am simply an accountant. My job is not to get into all this. My job is simply to get the fair value of planned assets and fair value of planned liabilities. My life is simple. Being an accountant, my life is simple. I don't want to bother myself too much. Is the reason I seek the help of an actuary who uses a technique known as projected unit credit method, and they predict that what will be the last known salary. On the basis of that prediction and on the basis of the profit or benefit defined by us, The benefit defined by us as a firm is we will give 1% of last round salary, 1% of last round salary for each year of completed service. So the moment an employee completes 1 year, the moment an employee completes 1 year, the employee is eligible to receive 85. But when will actually pay the employee? The employee is eligible to receive. The employee is eligible to receive 85. But when we will actually pay this 85 to employee, we will pay at the end of 5th year. An employee became eligible at the end of year 1. How many years left to be paid? How many years left to be paid? How many years left to be paid? 1, 2, 3, 4 years to be paid. Most of the people commit the mistake of saying 5 years. It's actually 4 years. Because at the end of year 1, the employee becomes eligible to receive. An employee will get at the end of 5th year 85. Employee will get 85 at the end of 5th year. So what is the present value of this 85 today? What is the present value of 85 which is to be paid at the end of 5th year today? What is the present value? What is the present value? We get to know the discount rate at the rate of 10% for 4 years is equal to 1 divided by 1.1 raised to power 4. Suppose the rate of discount for a government bond is say 10%. That's the rate of interest for a government bond. So we use it as a discount rate. In IFRS it is even deep bonds are also allowed, but in India, in Ind AS only government bonds are allowed, so we take that rate. Year 2, employee becomes eligible to receive 85 more. But how many years? 3 years. After 3 years, employee will get. Year 3, the employee completes 1 more year, becomes eligible to receive 85 at the end of 5th year. Employee completes 1 year, eligible to receive 85 at the end of 5th year. What is the present value today? The present value of 85 which the employee will receive at the end of 5th year will be equaling to, today it will be equal to 58. The employee is eligible to receive 85 at the end of 5th year, but the present value of that 85 today is equal to 58. That's the present value today. That employee is eligible to receive this 85 at the end of 5th year, but today the value is only 58. That's the present value today. Employee completes 2nd year, employee is eligible to receive 85 at the end of 5th year. What is the present value today? The present value today is 85 into 0.751, 64. Employee completes 3rd year, eligible to receive after 2 years 85. What is the present value today? After 2 years, the employee will receive. So the present value today is 70. Employee completes 4th year, eligible to receive 85 more. But at the end of year 1, employee will pay. Employee completes 5th year, eligible to receive 85. How much employee will get? Employee will get 85. Employee is eligible to receive 85 because the present value of 85 at the end of year 1 is 85. So this is the eligibility, but the amount is being received at the end of, all the amount is being received at the end of 5th year. How much amount in total? 85 plus 85 plus 85 plus total 425 will be paid to this employee, but this 425 will be paid to this employee at the end of 5th year. Do we need to be prepared for this? This is projected unit credit method. 1% of last drawn salary for each year of completed service. Last drawn salary is 8500. 1% of it is 85. 1% of last drawn salary for each year of completed service. The employee is eligible. Employee is eligible to receive 425. But the moment an employee completes 1 year, we need to be prepared. How did we get prepared? How do we get prepared? We had set up a liability. Opening balance is nil. Opening balance is nil. Current service cost. Current service cost, employee completed 1 year, is eligible to receive 58. During the year, interest cost 10%. 10% of it 5.8 is interest cost. Closing balance 58 plus 5.8 58 plus 5.8 64. This was the position in year 1. Year 2, the opening balance is 64. How much is current service cost? How much is current service cost? The employee completes 1 more year, becomes eligible to receive 85 more, but that too at the end of 5th year. The present value of this 85 today is 64. Current service cost is also 64. Interest cost is 10% of it. The total closing balance is equal to this plus this plus interest. The first year there was no interest charge, sorry. First year there was no interest charge because the employee is eligible to receive this 85 at the end of year 1, eligible to be paid at the end of year 4, 4 years charge. So the present value at the end of year 1 is 58. So at the end of year 1 we didn't have any opening balance, we had only closing balance. And this valuation is being done by the actuary. This closing balance is given by the actuary. Fair value of planned liability is given to us by the actuary. This becomes the opening balance next year, 58. The current service cost is 64. Interest charge on it is 6.4. The closing balance turns out to be 128. At the beginning of year 3, this becomes equal to 128. Current service cost this year. 3rd year current service cost is 70. 70 current service cost. Interest 7. Closing balance 206. Year 4. Opening balance 206. 77. Interest cost 7.7, closing balance 291. Year 5, opening balance is 291. Employee is eligible to receive 85 at the end of 5th year. Completed 5th year is eligible to receive 5th year 85. The interest on the opening balance, interest on the opening balance and closing balance is equal to 425. This is what we were liable to pay. We were liable to pay 425. Am I right? We decided that we'll be paying 425, 1% of last term salary for each year of complete service. We are liable to pay 85 the moment employee completes 1 year. But the present value of this 85 today is 58. So we'll recognize at the end of year 1 a liability of 58. What will be the entry? Expense account. We'll charge current service cost debit and will be liable to pay this amount, create a liability of 58 at the end of year 1. Expense account debit to liability 58. This liability becomes the opening balance. There is an interest charge on this. This will be presented as interest expense. This interest cost will be presented as interest expense. Interest expense will also be charged to profit and loss account. And we are liable to pay interest expense as well as the opening liability. This year again the employee completes 1 more year. If the employee completes 1 more year, the employee is eligible to receive 85 at the end of 5th year. The present value of this 85 today is 64. So the total liability increases to 128. Third year becomes the opening balance. Suffers the interest charge for the year. Adds the current service cost for the year. Liability at the end of year 3, 211. Beginning of 4th year, 211. Current service cost 77. Interest cost 21.1. And closing balance at the end of 4th year is 309. 5th year opening balance. Current service cost is 85, interest cost is 30.9, and we were liable to pay, or we had to be prepared for being able to pay 425 at the end of 5th year. So on the basis of projected unit credit method, we started preparing for it. So if I summarize it, how it will appear in accounting. In accounting, you simply need to record profit or loss, assets, unrecognized actuarial gains or loss, unrecognized actuarial gain or loss, and L is liabilities. P profit and loss, A assets, unrecognized U, L liabilities. You simply note down the entries to be done. This stands for opening balance. O stands for opening balance. B stands for benefits paid out. I for interest expense. S for service cost. Service cost, whether current service cost or past service cost, both. Whether current service cost or past service cost, whichever. They are under the head service cost. These two are under the head service cost, because they are treated in the same manner, whether current service cost or whether past service cost treated in the same manner. C for contribution. This contribution is to the fund. U for unrecognized actual gains and loss, unrecognized actuarial gain or loss. I for interest income, and T for total. If you make this chart, you can easily do any employee benefits question easily. You simply need to build this chart. Profit or loss, assets, unrecognized actual gains and losses, L. O for opening balance, BISCUIT. Benefits paid out, interest expense, service cost, contribution, unrecognized actual gains and loss, interest expense, and T for total. Once you have this chart in front of you, you can easily build up the accounting. Then thereafter there is nothing in it. We can easily build up the accounting. Current service cost or past service cost, as I said, is one and the same thing. One and the same thing in the sense that if you have been providing this benefit in the past and if you change the rate, suppose we were providing 1% of last term salary, you may change the rate to 2% of last term salary. So if there is any additional liability, that is also debited to P&L, and what will be credited to liability. Whether it is current service cost or past service cost, we simply debit past service cost and credit liability. There is no other option. So this is treated in the same manner. Debit P&L, and credit liability. Debit the profit and loss account and credit the liability, whether current service cost or past service cost. Current service cost is the moment an employee completes 1 year with the firm has to pay. Like in our example, the current service cost was 58. The liability is The liability is 58. The moment an employee completes 1 year with the firm, the employee is liable to pay 58. So at the end of year 1, the closing balance will be 58. Closing balance total will be 58 because that's the balance at the end of the year 1. That was the balance at the end of year 1. Against it, the actuary may guide us that we should contribute to the fund every year 100. If we contribute to the fund 100 every year, then 100 will be debited to the assets. 100 debited to the assets, and credit will be cash. Credit account will be cash account that we contribute 100 to the fund. When we total up the planned assets and planned liabilities, we get to know that total is 100 in terms of assets debited and total liabilities are 58 credited. When we look at the total of assets, we get to know that total assets will be 100 and total liabilities will be 58. Suppose it is actually exactly we are able to predict, and we'll simply record net planned assets or net planned liabilities. So first year will not give us good example. Let's see the second year. Second year, the opening balance is, for planned liabilities it is 58 credited. For planned liabilities it is 58 credited. The opening balance of planned assets is, say, debit 100. So this is what we have thought of. During the year, current service cost of second year current service cost was 64 was the current service cost. So 64 gets debited as part of P&L. 64 debited as part of P&L. The same 64 gets credited as part of the liability in total. During the year, there is an interest expense. During the year, there is an interest expense of, on 58, there is an interest expense of 5.8. So we recognize this interest expense of 5.8 as debit 5.8. At the same time, we credit the liability. Credit 5.8. Our opening balance is 100. So the income during the year, interest income will be 10% of it, debit 10. And if it is debited 10, what will be the credit? Credit will be income in the P&L 10, credit 10. Debit assets by 10 and credit P&L by 10. And suppose we are contributing to the fund 100 every year. So debit 100, credit cash 100. That goes out to the chart. When we contribute to the fund increases by 100, but credit is cash. Now suppose there is a benefit paid out of 40 during the year. What will be the entry if we pay out a benefit of 40, or say 20 is the benefit paid out during the year? Let's not increase it more. Let's 20 is the benefit paid out. What will be the entry for 20 benefit paid out? If 20 is the benefit paid out, our assets are standing at 100. If 20 is the benefit paid out, I'll credit this 20 and I'll debit the liabilities also by 20. Sometimes you'll be given net assets figure. Net assets means assets minus liabilities 20. Net assets means assets minus liabilities 20 is the net assets. If you reduce 20 from net assets, you're automatically reducing from assets 20 and you're reducing 20 from liabilities. Please be careful. When you are facing a problem, it may be directly dealt with in the net assets. When you directly reduce 20 from net assets, you're automatically reducing the asset by 20 and you're automatically reducing liability by 20. So the assets reduced by 20, the liabilities reduced by 20. These are the benefits paid out. These are the benefits paid out. What should be the total? What should be the total of assets? What we need total of assets and total of liabilities. That's what we need. Total of assets and total of liabilities. When we did total of assets, we got to know that it is equal to 100 minus 20 plus 100 plus 10. It should be equal to 190. Should be the total given to us by the actuary. What should be the total of liabilities? Total of liabilities. Total of liabilities is equal to 58 minus 20 plus 5.8 plus 64, 107.8. Suppose this is also given to us by actuary. The actuary gives us the total which exactly by chance matched with what the entries we did. But in reality, this is not life. In reality, this is not the life. The actuary gives us the fair value. Actuary gives us the fair value and turns out to be that the fair value of planned liabilities, the fair value of planned liabilities at the end of year is equal to 140. Actually says fair value of planned assets at the end of the year is equal to 170. So in a single item it will be presented in the balance sheet. Net defined benefit plan asset is equal to 170 minus 140. Whatever is higher will become the plan assets. So net defined benefit plan asset will be recognized at an amount of 30 in the balance sheet. This is the fate is written by the actuary, that this is what you need to show as part of the balance sheet. Now we are wondering that we were doing accounting since beginning and our total was actually 190, but actually says that this total should be 170. What about the difference of 20? What about the difference of 20? That means the difference of 20 is a gain or loss. Assets we were expecting it to be 190, but expects actually reached 170. So minus 20. Minus 20, how to reduce this minus 20? Credit 20. In other words, loss of 20. The total we ended up the total of 190, but in reality the fair value of planned assets is only 170. So there is a loss of 20 here. There is a loss of 20. When we totaled up liability, the liability said 107.8, but in reality the liability is 140. In reality the liability is 140. That's the fair value given by the actuary. So 107.8, actually 108. The liability has also increased by 32. Again a loss. Right? So that means in spite of recording everything, there was one amount which remained unrecorded. This is known as unrecognized actuarial gain and loss. In spite of being able to do the accounting throughout the year, in spite of doing the accounting of opening balance, we got it. So whatever is the closing balance, this becomes the opening balance next year. Whatever is the closing balance, this becomes the opening balance next year. In spite of recording everything during the year, we recorded the opening balance, benefit paid out, interest expense we recorded, service costs also we rightly recorded, we recorded the contribution paid out, we recorded interest income correctly, but in spite of that, when we totaled up the opening and closing, there was a difference. This difference is known as unrecognized actual gains and loss, and unrecognized actual gains and loss is recognized as part of OCI, other comprehensive income, and the total loss of 52 will be recognized as part of OCI. This is the role of defined benefit plans standard which guides us how to record these OCI balances. We record an OCI of 52. When we totaled up the asset, we got to know that we suppose that it should be 190, but it's actually 170 only. So there is a loss. Our liability we were expecting to be only around 108, but it turned out to be 140. That means there is a loss. This loss remains unrecorded, unrecognized. So unrecognized actuarial gain and loss is forming part of other comprehensive income. If I directly look at so if I sum it up, the closing balance of this year becomes opening balance next year. So at a certain point in time, the opening balance is also given by the actuary. Can I say so? The opening balance is given by the actuary. The closing balance of fair value planned liabilities at the end of the year, fair value planned assets at the end of the year is given by the actuary. The actuary, through actuarial assumptions, will assume the projected unit credit method, will assume what will be the liability on the basis of funds. They'll assume that this is the projected liability. They'll give us the figure at the end of each year. But during the year, we are successful in passing the entries. What are the entries we are successful in passing? If we have paid out any benefit, we credit the asset, we debit the liability. If there is an interest expense, we debit profit and loss account, we credit liability. If there is any service cost, we debit P&L account, credit liability. Service cost can be past service cost or current service cost. The treatment is same. Current service cost or past service cost, debit P&L and credit liability. Current service cost or past service cost. Even if it is a past service cost, it is also recognized in the same year. We do not do any restatement. Whatever is the additional liability, we'll charge it immediately, debit P&L and credit liability. We'll simply increase the liability. If there is any contribution paid out to the fund, the asset gets debited and credit gets cash. Cash being paid out to the fund. So if your contribution to the fund, if there is any contribution to the fund, now this fund we are creating to be able to meet this liability, we are contributing to the fund. If there is any contribution to the fund, that is an asset, debit, credit cash. This will weight interest income, credit P&L, debit asset. Now the opening and closing balance are given to us. Opening and closing balances are given to us. In between we have done some transactions, benefit paid out, contribution to the fund, interest income. The balancing figure will be unrecognized actual gain or loss. Same thing we'll do here on the liability side. Opening balance, closing balance. Benefit paid out, we reduce the liability. When we paid out the benefit, we reduce the liability, debited. Interest expense increases the liability. Service cost increases the liability. Current service cost increases the liability. Past service cost increases the liability. When we total up between opening and closing, we get to know that there is a difference which has remained unrecognized. In spite of being careful, in spite of being logical, in spite of doing everything we could do as an accountant, we recorded whatever we could record. But actuarial assumptions result in a different fair value planned assets and fair value planned liabilities at the end of each year. Different fair value planned assets and fair value planned liabilities each year, resulting in a balancing figure in the liabilities as well. So total impact of this balancing figure in liabilities and this balancing figure in assets results in giving one amount of unrecognized actual gain or loss, which is supposed to be recognized as part of OCI. Recognized in other comprehensive income. This unrecognized actual gains and loss is recognized in other comprehensive income as part of OCI. So this is the summary of dealing with defined benefit plans, that if there is any exchange difference, if there is any balancing difference between the entries we could pass throughout the year, entries which we could not pass throughout the year, any difference is recognized as part of other comprehensive income. In case of other long-term benefits, we may give some defined benefit in similar manner, but in that scenario the difference will be taken to profit and loss account. So only in case of defined benefit plans, we take it as part of OCI. Defined benefit plans. Only in case of defined benefit plans, we show it as part of other comprehensive income. Defined contribution plans are very straightforward. We do not need to take the help of an actuary. In case of contribution plans, provident fund, expense account, pay the liability, job over. In case of other long-term benefits, you still may involve an actuary, may define a benefit of other long-term benefits if that's the case. If we need actuarial assumptions in case of other long-term benefits as well, then if there is any unrecognized gain or loss which shows or which remains directly as part of profit and loss account. But in case of defined benefit plans, simply follow this chart. You will not commit any mistake. If you simply follow this chart, you can do any question relating to defined benefit plans and you will not be committing any mistake because you are taking care of each and every transaction within this chart and you are easily able to deal with it. If there is any difference, that is shown as part of other comprehensive income. Now if you remember, in Ind AS 1 presentation of financial statements, we said that offsetting is not allowed. But at the same time, we said that there are certain areas where offsetting is allowed, like deferred taxes, and one was this fair value planned assets and planned liabilities. So whichever is higher will either show one net amount, net defined benefit plan asset or planned liability. Net defined benefit plan asset or planned liability will be presented as a single line item in the balance sheet. Sorry. Defined benefit interest expense. Defined benefit interest expense or defined benefit interest income are also presented as a single line item in the income statement. Net defined benefit interest income or expense, one single item is presented as part of the balance sheet. So this is all about the insights on Ind AS 19 employee benefits, mainly covering the defined benefit plans. So I would request you to go through it again through the lecture if you have not understood anything, and you can be in touch with me through the Unacademy portal. I am offering my services on Unacademy portal through CA final financial reporting based on Ind AS and offering the subject based on Ind AS. You can use the code ACC Amit, and there is an offer going on till 22nd July. There's an offer going on that you can avail the courses on Unacademy at a 80% discount if you use the code ACC Amit. So using the code ACC Amit, you get a discount of around 80% and you will get it 1 month subscription at just 999. You'll be able to get 1 month's subscription for just 999. And you can experience the quality of lectures of all the top educators on Unacademy who are teaching financial management, taxes, financial reporting, law. There are courses going on or there are upcoming courses which you can avail and can get the maximum benefit with the insights of all the top educators at one platform. So this is an opportunity for every student to use this 1 month subscription, which is part of the offer, available only till 22nd July. So do not forget to avail the offer and get benefited out of it with the insights from the top educators for almost all the subjects. Like even if you wish to get insight on other topics like derivatives, company law, GST, financial management, financial reporting, insights of other educators as well. So there are other educators as well who are teaching the same subject on Unacademy. You can have a view from their perspective as well. So this is all for the day. I would request you to follow me on Unacademy. My name is ACC Amit Kumar on Unacademy, and I use the code ACC Amit. So if you or any of your plans, if you or any of your friends are planning to subscribe to any course on Unacademy, you should use the code ACC Amit. And if you are a CA finance student willing to get insights, get clarity, this can also be served as a demo. You can avail these courses at a price of just 999. So this is all for the day. Thanks for your valuable time. Thank you.